Hi, this is Robbie Thomas, your Bay Area downsizer with Realty Experts. Please visit my YouTube channel, Bay Area Downsizer, for regular updates about the market. Let's go down the charts list. I've created about 50 plus charts, and it's going to be very detailed and data oriented and could take a little time. So I'll be moving through them pretty fast. Um, my absolute favorite line, which I often quote to my clients, is the in times of uncertainty, people follow the certain. Yes, that's so true because we're going through some real uncertain times right now, and bringing that clarity to that marketplace is what I really focus on, and that helps me show that there's value in understanding the real knowledge and the data driven information where people or the marketplace can make their own decisions on what to do, take action, basically. So let's go in. Let's look at the mortgage rates first. The mortgage rates have gone up and they're currently around the 7%, 6.8, 7.1%. Basically, what are they? They are determined by the 10-year yield and the spread above it. So this is the Fed rate at 4.21, let us say, for example. And then there's an additional add-on, which is the spread that the banks add on for their operating costs, for their margin, for their um, you know to pay whatever they're carrying costs. That's what this is, the margin in which the banks operate or the mortgage lenders operate, and that is tagged on top of the Fed interest rate, which is at 4.21, and that adds to the total of 7.1 percentage in this particular chart. This is what is eventually sold in the retail market, where the home buyer gets to take a 30-year fixed loan. This is what they are charged at that point. So let's look at some of the industry experts and what they say. So over here, the chief economist at First American, what he said is, Mark says that a primary driver of the increase in the yield over 2023 was inflation expectations. So the higher the interest rate of inflation, and more importantly, the higher the expected future rates of inflation, the higher the yield on the 10-year, as investors demand to be compensated for that inflation risk into the future. The CPI history pausing rate cuts that happened recently, this last week actually, is like, if you look at the 1980s, CPI went up to 14 point something percent and fell in the 1980s again to about the less than 2%. Now, like, you can see, although it has been trending lower, you see these peaks over here, these two big circles over here. And what we have today is the CPI data shows that the CPI numbers were over 8 at some point, and now has been trending slightly lower, but not low enough for the Fed to continue to pause rates or even lower rates. So we are now below 4%. Let's look at the next chart. This is also showing the same thing, but in a line diagram. Let's look at what else another industry expert is saying from Moody's Analytics. Mark says that the policymakers now risk committing another policy error, this time by waiting too long to begin cutting interest rates. It is unclear why Fed officials feel it necessary to take this risk. After all, they've all but achieved their dual mandates of a full employment economy and low and stable inflation. Now, let's look at the mortgage rate projections from Fannie Mae. First quarter of 2024, in December of 2023 was 7%. Now in February, which is last month of 2024, is 6.5. So it's dropped by 0.5%. And quarter two, December 2023 was 6.8%. Now it is 6.3% in February. Quarter three 2024, December 2023 was 6.6% projection, and now in February 2024 it is 6.1. 2024 quarter four is 6.5 and now 5.9%. Let's look at the next one. Let's look at the economy. Now, this chart shows more economists now see a soft landing. Initially, in January 2023, 61% of people said, "Oh, there's going to be a recession in the next 12 months." 39 said, "No, it's not going to be a recession." In January 2024, 39% of them are saying, the economists say that there's going to be a recession, but 61% are saying it's going to be a soft landing in the next 12 months. Then let's look at what the senior economist at Lending Tree says. At least right now, the fundamentals of the economy, despite some hiccups, are doing pretty good. While things are far from perfect, the economy is probably doing better than people want to give it credit for. Let's look at what the foreclosure data is telling us. So you look at all the foreclosure metrics; they're all completely down, and it's at minus 17.9%. So if there's no foreclosures, there's no much inventory coming into the market. So this is 25% below pre-pandemic levels. Over here is minus 17.9% right now. So let's look at the US foreclosure activity increases from 2022, but still below pre-pandemic levels. So you can see it's in 2023, there's nationwide only 357,000 foreclosures, while in 2009 it was 2.8 million, and in 2010 it was 2.9 million. Um, Over 1 million fewer foreclosures in the last 5 years. So you can see the complete stagnation, or rather severe drop, so to say, in the last 5 years. 1.45 millions and 749 fewer foreclosures in the last 5 years. So Black Knight, the mortgage monitor, in December 2023 says the prospect of any kind of near-term surge in foreclosure activity remains low, with start volume still near 40% below pre-pandemic levels. So inventory for the foreclosure, as we saw earlier, is much lower, it's 40% below pre-pandemic levels. Let's look at what how much equity most people have in their homes. Um, Americans sitting on tremendous equity, 67.4% have paid off their mortgage or have at least 50% equity. So the pie chart over here shows 38.7% of the green own the home free and clear. Blue shows 28.7% mortgage homes with greater than 50% equity. And the orange over here shows 33% of mortgage homes with less than 50% equity. Let's look at home prices charts right now. Home consumer confidence in home prices. Persons who believe home prices will go down in the next 12 months. The talk of repeat of 2008 crash, you can see that it peaked somewhere in January 2023, and it's been steadily falling, as we saw in the previous chart. The Case-Shiller prices month over month percentage change in home value seasonally adjusted shows the prices, although are on the positive, they are slowly reducing. You can, as you can see in these bar charts. So let's look at the final 2023 home price appreciation rates based on the entity that has been tracking it. Case-Shiller shows 5.5% increase in home appreciation. CoreLogic shows 5.5. Black Knight shows 5.6. Freddie Mac 7.0%, and FHFA shows 6.6%. The Case-Shiller 2023 home price appreciation on the 20 city index also shows um, the various things. Some of the highest is at about 8.3%, and the lowest at Portland, which is 0.3%. Let's look at what Brian says, the S&P Dow Jones indices. Looking back at the year 2023, appears to have exceeded average annual home price gains over the past 35 years. While we are not expecting the double digit gains seen in the previous 2 years, above trend growth should be well received considering the rising costs of financing home mortgages. Yes, the amount of annual home appreciation from 1980 to 2023. Uh, you could see that there's a steady rise. And if you look at the 5 year 5% as a baseline, the only few years it dipped was in the 1990s. And then if you look at the 2022 23, it still peaked in 2022. It's still above 5%, but it is still on the green. So you don't see any serious price drops yet. Now, FHFA prices month over month percentage change in home values is also on the green. There's nothing on the red yet, although it is much lower now in December. It's about a 3 month delayed data, but it's still on the green. Let's look at what FHFA says on house prices data. House prices rose in 49 states between quarter four of 2022 and quarter four of 2023. House prices rose in 96 of the top 100 largest metropolitan areas over the last 4 quarters. All nine census divisions had positive house price changes year over year. This chart shows a state by state how much it increased, and it's coded by the colors over here. Now let's look at percentage change in home values month over month, Case-Shiller versus FHFA. The Case-Shiller shows over here in January 2023 there was a point minus point two dip, but if you look now, as it kept growing green on point 0.9 at the peak, and now in December at point 0.2. Well, FHFA in January 2023 showed point 0.1 increase our change, and in December showed point 0.1. Let's look at the home sales forecast. So this is from CoreLogic. As mortgage rates continue to hover in the 7% range, it will be difficult to convince existing homeowners to move at the current time. Nevertheless, as recent surge in mortgage application data has shown, following a drop in rates, buyers are anxiously waiting to jump into the market. That means that 2024 is likely to show another year of home price highs. So in 2024 home price forecast, the entity and the original forecast versus the current forecast. Goldman Sachs 1.9%, current forecast 5.5. Mortgage Bankers Association 1.1 was original forecast, current forecast 4.1 percentage. Zillow original forecast 0.2%, current forecast 3.5%. Fannie Mae 2.8%, current forecast 3.2%. Freddie Mac 2.6%, current forecast 2.6%. Home price expectation survey 2.2%, now it is 2.4% forecast. National Association of Realtors 4.7% original forecast, and current forecast at 1.4%. The estimated home price performance from December to December as forecast in quarter one of 2024 is at 4.11%, and 2028 and 2024 it shows 3.7%. So you can say that the only time it's going to take a supposedly going to take a dip is to in 2025 to 3.36%. Existing home sales since January 2014, it reached a peak in January of 2021, somewhere in the end of 2020 and 2021. to close to 6.8 million. And now in January of 2024, you can see it's at 3.9 million, or less than 4 million. So existing home sales have dropped drastically. This is another bar chart using region wise existing home sales. Total US dipped by 1.7%, Northeast minus 5.9%, Midwest minus 3.1%, South minus 1.6%, and in the West has gone up by 4.3%. New home sales annualized in thousands. So what we saw earlier was the existing home sales charts. Now we're looking at the new homes. Analyzed in thousands, the new home sales have gone up by, uh, again, you can see the similar chart. It peaked in 2020, 2021, and now, although it's slightly steadily climbing, it's still lower than the 750,000. It's probably a little above the 660,000. This is nationwide. So new home sales percentage of distribution by price range. So if you look at over 750,000, 8%, and less than between 150 to 499,000, 1%. And the highest is between the 300 to 399,000, which is 17%. Let's look at the new homes selling period. So, if you look at the median months for completion to sold, so from the time the home is completed to the time it's selling, um, you could see over here in January, uh, February, March. In March, it peaked at 5.1. It took 5.1 months from completion to sell. But now in January 2024, it is 2.8 months. That means the new home sales are also higher. I mean, it was selling faster in um, September, October at 1.5 months. So although it's a slightly delayed by a month, it's still selling within the 30-day period. Pending home sales. So this is a great indication of what the market is actually absorbing, because what is pending is not available for sale anymore, and that creates the uh, the demand and supply equations which you can study. So the historically healthy level is about 100 on the chart, and again you can see again it peaked around the end of January over here at about 120, close to 130, and now in January it's fallen. In February it's fallen again. It's less. It's little above 70, but so it's really a very tight sellers market. Percentage of distressed property sales. Distressed sales, foreclosures, and short sales represented 2% of sales in January. And that's it. You can see the chart from 35% in 2012. It's gone down to this level where the 4% was low. Now it's lower than 3%, I would say. So it shows here as 2% in sales of January. So there's hardly, let's say there's very little distressed property sales. Existing price of sales price of existing homes. Total US, it was 5.1%. It went up. In Northeast, 10.1%. Midwest, 7.6%. In the South, it was 4.1%. In the West, 6.3%. Percentage change in sales. And this is by price. So if you look at it, it's up 0 to 100,000 minus 13.1%. It went below. 100,000 to 250,000 minus 7.9%. 250,000 to 500,000, 4.6%. 500,000 to 750,000, it went up by 11.4%. 750,000 to 1 million price range went up by 22.5%, and the 1 million plus price point went up by 27.1%. change in home prices year over year for a 20 city composite, you can see that the prices are falling, but that's November and December. I mean, we don't have the data yet for the 2024 up to March, but it has been steadily falling. The forecast in US home price insights is um, to 2.8, and the current is at 5.5%. Let's look at the home inventory because that shows supply. Months inventory of homes for sale from 2011 to today shows a steady decline in inventory. It was at 9.5 in January, February, around March, April of 2011, and now in 2024, it's little less than 3.5%. Months inventory of home for sale. As we saw in the new home chart earlier, this is for all homes since 2019. It shows 3 months of inventory. That means any home, any square footage, any city, whatever comes on the market in any condition gets sold around within 3 months. So the absorption rate is about 3% or 3 month. Um, this shows a slight climb in inventory in January 2024, but not much. Year over year inventory levels, you can see the steady climb over here, but it is not climbing to the healthier numbers like in February of last year. Still way below February of last year. Last year it was 15.3%. Now in January it is 3.1%. So now let's look at the new home monthly inventory. The new home monthly inventory is actually helping to a certain degree because the resale or the um, pre-built homes for older neighborhoods are not coming on the market. The new homes are coming on the market, but it's still only 8.3 in January 2024. Non-seasonally adjusted between 2023 and 2024, the darker blue is 2023 and the lighter blue is 2024. And you can see in January it was 8.1. Let's look at the buyer demand. Now, we've seen the supply side. Now let's look at the demand side. Showing Time is a third-party app which was acquired by Zillow a couple of years back, and they track the number of people who are actually seeing the houses which are on the market. So if you look at the showing index still remains above pre-pandemic levels. So during the pandemic, it was around 152.5 to 235 over here. 252.1 was the peak in 2022. Pre-pandemic over here, it was 141 and 152.5 in 2020. But pre-pandemic, these two, 141.1 and 127.6, and over here in 2024, you can still see the showings are still higher than the pre-pandemic level. That means there's renewed interest in seeing the homes. Mortgage rates. So the 30-year fixed rate is what generally most people go for. So tracking that from January 2018 till up to recently, which is now at 6.94%. So you can see that the interest rates have steadily gone up. It peaked around 7.66, 7.7 the last year in 2023. Now it's come down a little bit, but it's still close to 7%. Now let's look at the mortgage rate projections in the next few charts. 2024, Fannie Mae says 6.5, MBA says 6.9, NAR says 6.8. Average of all three is 6.73 for the first quarter of 2024. Second quarter, the average is 6.5. Third quarter, the average is 6.23, and the fourth quarter, 6.03 but still projected to be above 6%. This is a different chart just for a visual understanding, a better clarity, that interest rates are still falling but elevated over 6%. Now, let's look at the mortgage credit availability because that shows how easily a buyer is able to get a loan. This is in January 2024. You could see it peaked in 2019, 2020 around 180, closer to 190 on the index, and now it has gone down to the 90, um, less than 100. So it's getting harder for home buyers to get a loan, but at the same time, it's the prices of the homes are still going higher because of the lack of inventory and renewed interest by buyers who have the money to buy existing inventory. And the lending standards during the housing bubble was 868.7, and now it is 92.7. That shows it's very tight lending standards that the banks or the mortgage companies are following. So I hope this gives more insight into what is happening in the larger market. For local market updates, please visit my YouTube channel, and I will be specific to region-wise updates on supply and demand, directly drawing data from the MLS, where you can infer through these data charts what is happening. You could also subscribe to my email through my website, bayareadownsizer.com, and also ask for a free, accurate comparative market analysis with no obligation to work with me. It's free and it's done completely different from a generic comparative market analysis because I do it personally. You can also visit my YouTube channel at Bay Area Downsizer or reach me directly at my number 510-374-2264. And above everything else, stay focused because during testing times, being focused will help you climb. Thank you for everything and please subscribe to my channel. Bye.